We are basically a neobank to a large degree, but people associate us still strongly with buy now, pay later. That was Sebastian Siemiatkowski, Klarna's CEO and co-founder, describing his company to investors in 2025. Klarna holds no United States bank charter, rents its banking infrastructure from a small institution called WebBank in Salt Lake City, and bears full credit risk on every loan it originates. A shareholder class action filed December 22, 2025, alleged the company misled investors by downplaying those exact credit risks in its IPO documents. The gap between what Klarna called itself and what Klarna actually was would cost shareholders billions of dollars in less than 6 months. In September 2025, Klarna raised $1.37 billion in its initial public offering, roughly the same sum Disney paid to acquire the entire Pixar animation studio in 2006. Klarna's stock then lost more than 75% of its value. If your retirement account held any of the growth-oriented or fintech-weighted funds that participated in that IPO allocation, this was not an abstraction. It hit your quarterly statement. You may not recognize the name Klarna, but you have almost certainly seen it work. If you ever watched a grandchild split a Kohl's or Target checkout into 4 easy payments around 2021 and thought, this is basically free money, that little logo at the bottom of the payment screen before they clicked confirm, that was Klarna. 118 million consumers across 26 countries use it. 966,000 merchants accept it. And the entire model depends on one bet, that the people borrowing money will pay it back. Here is what this story is really about. It is not whether Klarna's stock recovers. The question is whether a debt collection company can rebrand itself as a global bank, sell that story to Wall Street for $17 billion, and walk away clean when the credit losses it was already accumulating surfaced weeks after the offering. And the pattern Klarna followed: delay the IPO, repackage the narrative, price above guidance, watch it collapse, is not unique to Klarna. At least 2 companies in your portfolio right now are running variations of the same playbook. If you suspect the companies managing your money are packaging risk in language designed to obscure it, and you want one documented case every week that proves whether that suspicion is justified, subscribe. The Debt Factory's Disguise. Klarna generated $2.81 billion in revenue in fiscal year 2024, its first profitable year after cumulative losses that had cratered its valuation from $45.6 billion in 2021 to $6.7 billion by 2022. CEO Sebastian Siemiatkowski and co-founders Nicholas Adelberth and Victor Jacobson had built the company in Stockholm in 2005 on a simple mechanism. A merchant adds Klarna to checkout, pays Klarna a 3 to 6% commission, and Klarna fronts the full payment to the merchant immediately. The customer owes Klarna. The most common arrangement was 4 installments, no interest, clean and simple. But underneath that clean surface, Klarna was always a credit operation. Failed payments triggered $7 fees. Financing terms on longer loans carried interest as high as 35.9%. In Europe, the company was dragged into court for charging €1.20 for a reminder email. Revenue breakdown from Klarna's own SECF 1 filing shows that in 2024, core buy now, pay later merchant fees accounted for $1.6 billion, 57% of revenue. But interest-bearing loans contributed $675 million, late fees added $254 million, and advertising revenue brought in another $180 million. Klarna was a debt collection company with a millennial-friendly checkout screen. Somewhere in Atlanta, there was a retail worker who used Klarna's Pay in 4 to buy a $200 pair of sneakers. When she missed one installment, she was hit with that $7 fee and discovered her financing terms had quietly shifted to a 36-month loan at 35.9% interest. A $200 purchase became years of compounding debt she could not exit. She was not an edge case. A study published in 2025 found that 41% of Buy Now, Pay Later users had been late on a payment, up from the previous year. These borrowers are disproportionately financially vulnerable compared to holders of other consumer debt. Siemiatkowski understood the math. Short-term, interest-free installment loans had terrible margins. The loans were small, brief, and generated revenue only when borrowers failed. He needed a different story, not just for the business, but for Wall Street. The same week Klarna filed for its IPO, it partnered with OnePay, Walmart's payment company, becoming Walmart's exclusive Buy Now, Pay Later provider and displacing Affirm overnight. Klarna issued OnePay warrants to acquire 15.3 million shares at an average price of $34 each, effectively paying Walmart in discounted stock for the partnership. Repayment options under the Walmart deal ran 3 to 36 months, with interest rates reportedly reaching 36%. In 2024, Klarna had claimed 99% of transactions on its network were interest-free. That claim was about to become obsolete. The pivot that proved the original model broken. The numbers told one story, the language told another. On the first line of its IPO prospectus, Klarna described itself as the global digital bank and flexible payments provider. Global digital bank came first. Flexible payments, what Klarna actually did, came second. Siemiatkowski launched a debit card, rolled out what the company branded fair financing, longer-term installment loans spanning 6 to 24 months with real interest, and refiled the IPO in September 2025 with banking as the lead identity. The strategy was legible. Interest in finance is the real moneymaker. Set the numbers aside for a moment. You remember 2021. Maybe your daughter or your niece showed you how easy it was. Tap, split into 4, no credit check, done. That tiny Klarna logo felt harmless, almost invisible, like a coupon. But what she was doing, and what 100 million other consumers were doing, was entering a credit relationship with a company that had no U.S. bank charter, that outsourced its regulatory framework to a single institution in Utah, and that was quietly shifting the terms of those relationships from short-duration, interest-free arrangements into multi-year, high-interest loans. The product that felt like a convenience was always a lending operation. The rebrand did not change what Klarna did. It changed what Klarna called it. Sebastian Siemiatkowski told analysts, "The momentum is undeniable. We're outpacing competitors, our merchant network is scaling rapidly, and our next-gen products are reshaping money management for millions." The record shows something different. Just weeks after the September 2025 IPO, Klarna reported a 102% year-over-year increase in credit loss provisions. Shares fell well below the $40 IPO price. The company posted a net loss of $95 million in the third quarter of 2025, down from a profit of $12 million in the same quarter the prior year. Transaction margin dollars, Klarna's own preferred measure of whether its core business worked, came in at $281 million, down from the same quarter a year earlier. The very metric Klarna told investors to watch was moving in the wrong direction. Klarna's pivot into longer-term, interest-bearing loans, the move designed to generate real banking profits and justify the IPO valuation, created massive upfront losses that wiped out profitability and proved to investors that the original Buy Now, Pay Later model was never actually sustainable on its own. The cure and the disease were the same thing. If you held shares through any of those Fintech ETFs that loaded up during the September offering, this was the quarter where the thesis broke. And nobody at Klarna told you it was breaking until the filing landed. On December 22, 2025, shareholder plaintiff Nayak filed a securities class action, case number 1:25-CV-07033, Eastern District of New York, alleging investors paid $40 for shares that soon traded in the low 30s. Kathrein of Hagens Berman stated, "When a company's credit loss provisions double almost immediately after going public, it raises serious questions about whether the IPO documents were truly transparent." Klarna responded that the allegations lacked merit. The case remains open. By the fourth quarter of 2025, Klarna reported its first billion-dollar revenue quarter, $1.082 billion. Gross merchandise volume hit $38.7 billion, but transaction margin dollars landed at $372 million, below Klarna's own guided range of $390 to $400 million. Siemiatkowski acknowledged it publicly. This quarter's transaction margin dollar result did not land where we guided. We take that seriously. The acceleration in lending growth is the primary driver of that outcome. Fair financing had grown faster than Klarna's own forecast, and that faster growth was what caused the miss. In that quarter alone, $2.5 billion in new loans carried $80 million in upfront losses against only $40 million in immediate revenue. The remaining $180 million in expected income from interest on those loans would arrive later, if borrowers paid as Klarna expected them to. The signal was there. It had been there for some time. The playbook. Everyone borrows. This is not a new story. The mechanism Klarna used, gut the workforce, rebrand the business model, rush an IPO before the new numbers can be tested, is being replicated across American industry right now. Salesforce, valued at $258 billion, announced it would cut 1,000 roles to hire AI sales agents. Meta plans to replace human staffers with AI for reviewing platform risks, automating up to 90% of assessments previously done by people. Duolingo stopped using human contractors entirely. CrowdStrike gutted its workforce and replaced employees with automation. The template is identical. Reduce headcount, claim efficiency, use the savings narrative to justify a valuation that the underlying economics do not support. Klarna cut its global workforce from 5,527 employees at the end of 2022 to 3,422 by the end of 2024. By May 2025, Siemiatkowski told CNBC the company had shrunk to roughly 3,000. An AI chatbot developed with OpenAI was performing the work of 853 full-time customer service agents. The company projected annual savings of $60 million. Glassdoor reviews rate Klarna's employee compensation at 2.9 out of 5. Siemiatkowski described the attrition as natural, 15 to 20% per year, he said, and projected headcount would drop to around 2,500 within 12 months. Sebastian Siemiatkowski made the decision to replace 1,000 workers with software. Those workers, many in Stockholm, some in global offices, received severance pay generally capped at twice their notice period. Over 550 accepted voluntary redundancy in the first round. Klarna noted that 70% found new jobs by summer. The company did not note what happened to the other 30%. The people who built the customer relationships that Klarna monetized at IPO were the same people Klarna removed to make the IPO numbers look efficient. The board approved the workforce reduction. The IPO prospectus highlighted the savings. The credit losses that followed were in the same document. Remember that retail worker in Atlanta? The one whose $200 sneaker purchase became a multi-year high-interest loan? She is the customer Klarna counted as active. She is part of the 118 million figure in every investor presentation. Her debt is on Klarna's balance sheet. And the person who might have helped her navigate a payment plan or flagged her account before the terms shifted, that person was replaced by a chatbot that saved Klarna $60 million a year. The decision maker kept his equity. The worker lost her job. The borrower lost her clarity. The shareholder lost 75%. In the first quarter of 2026, Klarna finally reported positive net income, $1 million, on revenue of $1 billion. The stock barely moved. Transaction margin dollars came in at $389 million, up from the prior quarter, but not by enough to change the trajectory. Fair financing was supposed to be the engine. Instead, it was the anchor. And the $8.3 billion lawsuit Klarna's subsidiary PriceRunner filed against Google, the largest civil damages claim ever in a Swedish court, with judgment now rescheduled to June 10, 2026, has yet to deliver a single dollar. Klarna's future depends on borrowers repaying long-term debt, a court ruling in Stockholm, and a stock price that has not meaningfully recovered since October 2025. Verdict. Klarna raised $1.37 billion from public markets by describing itself as a global digital bank. It was, and remains, a company that lends money to consumers at high interest rates, outsources its banking charter to a single institution in Utah, and bears full credit risk on every loan. The IPO succeeded not because the business model had been proven, but because the language around it had been changed. 1. Sebastian Siemiatkowski delayed the IPO, rebranded the company from a payments processor to a bank, and priced shares above guidance at $40, while credit loss provisions were already accelerating at a rate that would surface publicly within weeks. The timing was not coincidence. It was sequencing. 2. The pivot into fair financing, longer-term interest-bearing loans, was presented as evolution. In practice, it front-loaded losses so large that they overwhelmed the revenue gains, missed Klarna's own projections, and proved that the original buy now, pay later model could not generate sustainable margins. The company's cure for its broken model created a new and more expensive version of the same problem. 3. The workforce reduction was framed as AI-driven efficiency. It was also a cost-cutting measure that made the IPO prospectus look leaner. The 853 customer service positions replaced by software did not just save $60 million. They removed the human infrastructure that managed borrower relationships. At the exact moment Klarna was issuing billions in new consumer loans that required more oversight, not less. The deeper pattern here is not about Klarna specifically. It is about what happens when a company that has never proven durable profitability is allowed to define its own category to public investors, then alter the terms of its core product after the offering is priced. Klarna did not fail because buy now, pay later was a bad idea. Klarna struggled because it built an IPO narrative on a business model it was already abandoning, funded the transition with public capital, and left shareholders holding the credit risk it had been accumulating for years. If you hold Fintech ETFs, consumer lending funds, or growth-oriented allocations in your IRA, the question worth sitting with is whether the companies inside those funds are reporting what they do or what they want to become. Klarna reported both, in the same prospectus, on the same page. The company that perfected the trick of calling consumer debt a technology product is still publicly traded, still issuing loans, and still describing itself as a bank without a charter. That mechanism is not unique to Stockholm. The documents are public. Draw your own conclusions.